welcome to your Monday Futures Market Outlook for June 21st, 2010. This is Patrick Serezna. For those of you that have not had an opportunity to try out eminisource.com, a 30-day complimentary membership is available, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. Many months ago, we bullishly crossed over that 80-week moving average and continue to hold above there. The question is, how does this whole thing play out into the summer? At this stage, the one probable scenario is that we continue to consolidate into the summer, finding S&P lows somewhere probably in the 1,000, maybe even as low as the 950 area, subsequently base and then turn bullish into the end of the year. But at this stage, we also technically cannot rule out the possibility that this has been nothing but one big retracing wedge that will have the market turn back down and become bearish again. Again, we don't favor that scenario, but at this point we definitely technically cannot rule that out. So we're waiting to see where and how far this entire consolidation over the summer months occurs before we change our thesis or have a different outlook than our current one. When we take a closer look at the S&P 500 using the daily charts on the E-mini futures contracts, we see that we had a very bullish breakout on the Chinese rebalancing their currency news. At this stage, we're right now in the middle of the retracement box that we've been drawing for the last couple of weeks up in the, now it's marked off as the 1110 to 1150 area. That 1140, 1150 area we continue to be suspect to be contain almost all market rallies. So we probably have even another 20 S&P points potentially higher that may occur. More than likely, we may even spend the entire week working up in this higher zone. So we're not necessarily bearish on a immediate term, but at some stage we do believe this entire rally will end up being one very big retracement wedge that will at some stage find a catalyst to begin a new round of selling. The first scenario is that selling from that wedge will just come back and retest the previous lows at the 1040 to 1050. But in the bigger picture, we think that the S&P has the potential to even go back down to the 1,000 level or lower. But at this stage, we just want to see where and how far this rally gets, and when it starts to top and get some signs of it actually rolling over. So our key points are our thesis since January 2008 continues to be that we're in a secular bear market. We're not going to change this thesis until we see how the current sell cycle in over the summer here plays out. We saw a short-term bottom obviously at that at 1040 level, so we're now working into that retracement zone up into the 1110 to 1150 area. Even if the market wants to rally on the short term, we continue to be very skeptical about the sustainability of this rally into the summer. We see very little catalyst for this market to suddenly come back to its previous highs or rally higher. So really at this stage, these rallies should be used as an opportunity to get out of positions that investors got trapped in, and more importantly to now buy some affordable put protection, which can be open as an outright put, or you can open as collar strategies or any other types of combinations to hedge downside risk. Next year, I want to take a look at the NASDAQ 100 using the E-mini futures contracts. The NASDAQ has actually had a very nice spike higher, working much deeper into the retracement box, which ends up near around the 1950 area on the upside. The NASDAQ has been holding up, but again, just like the broader markets, we are skeptical about its sustainability up into these higher zones. At this stage, we'll see where this morning's rally ends up taking the markets or into the next, into tomorrow. But we will at some stage be looking for the markets to start losing some momentum up here. Next year, I want to take a look at the US dollar index futures, and more or less the dollar continues to consolidate as the euro works its way higher on the upside. At this juncture, there is a short-term support right here at this 85.50, 86 zone where we've marked off the area. This would be a very logical place for a short-term low, but from a retracement perspective, the dollar may work its way even as low as the 83.5 area during this cycle. I doubt it would go there in a straight line first. More than likely at some stage here we might get a bounce that sees a move potentially come back toward the 87 level, and then subsequently maybe come back down and retest that zone. But at some stage we're expecting the dollar index to start bottoming as we see very little catalyst for the euro to actually make some sort of robust counter rally. Next year, I want to take a look at gold futures, and we had a bullish gold trade even published on our service. We were looking for an upside breakout here. Nice technical move on the upside. First off, we had some good tests of this 1245, 1255 area, so it's very significant that gold was able to make that push above those previous highs. At this stage, the measured move higher on gold has us going to this 1275 to 1300 level, but that's only initial targets. There are some bigger picture moves that could have gold going as high as 1350 if some catalyst drives gold to really start accelerating on the upside. Nonetheless, there's very little reason to be, at least on the short term, bearish on gold. Next year, I want to take a look at crude oil futures contracts. I'll be using the mini contract. At this stage, this is also working out to being a very nice clean wedge higher right up into the top end of the retracement zone. Oil probably can work itself up towards $80 even on the upside. Maybe a very short-term spike above 80 and returning back down. But at this stage, we're skeptical about the sustainability of this oil rally and believe when oil finishes this little move, that at minimum will come back and retest the 6870s zone, if not push itself right down into the mid-range of the 60s on the downside. Finally, I want to look at 10-year Treasury note futures contracts. So at this stage, we were at least at some stage considering that this could have been a sideways triangle consolidation. But at this stage, with this trend line being drawn, the price action we're seeing here initially, at least is giving indication that we may in fact have a zigzag correction in the Treasury notes, which could see us come down and retest not only 18.5 to 19 level, but could potentially go even as low as the 118 or 117.5. But with any retracement down into that lower level may only create a good buying opportunity for Treasuries. So even though maybe we're right now considering some short-term weakness, it's not making us bigger picture bearish on the Treasury notes. That was your Monday Futures Market Outlook. Thank you for joining me.